What I'm about to explain may completely change the way you think about money, savings, and the global financial system. I'm Ray Dalio. I've spent more than 50 years studying economic cycles, reserve currencies, debt crises, and the rise and decline of empires. I've watched how wealth is built, how wealth is destroyed, and more importantly, how wealth survives when the monetary system begins to change. And right now, there is something happening in plain sight that most people are either ignoring or misunderstanding. Central banks around the world are buying gold at a pace we haven't seen in decades. They are not doing it for tradition. They are not doing it for symbolism, and they are definitely not doing it by accident. They are doing it because they understand something very important about the world we are moving into. They understand that when debt gets too large, when monetary expansion becomes unavoidable, and when confidence in fiat currencies begins to weaken, the rules of money start to change. And when the rules of money begin to change, the people and institutions who prepare early preserve their purchasing power, while everyone else slowly watches theirs erode. Most people still think of money in very simple terms. They think that if they earn more, save more, and hold more currency, they are becoming safer and more secure. Psychologically, this makes sense. You open your banking app, you see a balance, and that balance feels real. It feels stable. It feels like wealth. But economics doesn't care how money feels. Economics cares about what money can buy. It cares about purchasing power. And purchasing power is not fixed. It changes based on supply, trust, debt, and the structure of the monetary system. This is where most people fall behind. They think in nominal terms. They focus on the number. Sophisticated investors, governments, and central banks think in real terms. They focus on what that number will actually be worth in the future. Once you understand that difference, you begin to see why central banks are buying gold so aggressively. Gold is not being accumulated because the world suddenly became nostalgic about ancient money. It is being accumulated because gold serves a role that fiat currency cannot serve when debt cycles mature. It cannot be printed. It is not someone else's liability. It does not depend on the credibility of a central bank, a treasury, or a political promise. Gold is one of the few monetary assets that exists outside the credit-based fiat system. And when central banks move toward an asset outside the fiat system, you should ask yourself a serious question. What are they trying to protect themselves from? To answer that, you need to understand where we are in the long-term debt cycle. Across history, when countries become successful, they usually go through a familiar process. Productivity rises, incomes rise, credit expands, financial markets deepen, the country's currency becomes stronger. Eventually, that currency becomes trusted globally and starts to function as a reserve currency. That status creates enormous advantages. It allows the country to borrow more cheaply, consume more than it produces, and finance its obligations by issuing debt in its own currency. For a long time, this feels like strength, but over time, if debt grows faster than productivity, the system begins to weaken underneath the surface. More debt requires lower interest rates. Lower interest rates encourage more borrowing. More borrowing pushes the system toward even greater dependence on monetary support. Eventually, the debt burden becomes too large to be resolved through normal growth alone. At that point, policymakers face the same set of choices every great power has faced before them. They can allow painful defaults, they can restructure obligations, or they can print money and reduce the real burden of debt through currency debasement. Historically, the path of money printing and monetary debasement becomes the preferred option because it is politically easier. Defaults are visible. Austerity is unpopular. Restructuring creates immediate pain, but inflation works quietly. It spreads the cost across the whole population. It allows governments to reduce real debt burdens without formally admitting failure. It acts like a hidden tax on anyone holding cash or bonds that do not keep up with inflation. And this is why gold matters. Gold becomes attractive when the real value of fiat money is under pressure, not because gold suddenly became more magical, but because paper money became less trustworthy. This is the deeper reason central banks are buying it. They are not merely diversifying reserves. They are hedging against a future in which fiat currencies, especially the major reserve currencies, face pressure from debt, monetary expansion, geopolitical fragmentation, and declining trust. This is not the first time in history that this has happened. The Dutch guilder lost its status. The British pound lost its status. The US dollar remains dominant today, but like every reserve currency before it, it's not exempt from long-term cyclical forces. No currency remains dominant forever. The reason is simple. Success creates excess. Excess creates debt. Debt eventually forces adjustment, and adjustment changes the monetary order. Now, when most people hear something like this, they immediately jump to extremes. They assume this means fiat money is going to disappear tomorrow, or that the banking system is about to collapse overnight. That is not how these transitions work. Monetary transitions are usually gradual, then sudden. For a long time, the old system continues functioning well enough that most people assume it will continue indefinitely. That is exactly why so many get caught unprepared. By the time the shift is obvious, asset prices have already adjusted, purchasing power has already moved, and positioning becomes far more difficult. The purpose of understanding this now is not fear, it is preparation. So let's talk more specifically about why gold is the asset central banks choose during these periods. Gold has one of the longest track records of any monetary asset in human history. Across thousands of years, through wars, defaults, regime changes, and monetary resets, it has preserved value in a way fiat currencies never consistently have. Every paper currency in history has eventually lost real value. Some declined slowly, some collapsed quickly, but none escaped the basic logic of excessive debt and money creation forever. Gold, by contrast, does not rely on promises. It does not rely on confidence in policymakers. Its supply increases slowly. It is globally recognized. It is liquid. And when confidence in paper assets weakens, capital naturally seeks assets with these characteristics. This is why gold should not be thought of primarily as a speculative trade. It is not just another line on a chart. It is monetary insurance. Insurance never feels exciting while everything is calm. It often looks boring. It can underperform productive assets during strong growth periods. But that is not the point. The point of insurance is to protect you during periods when the system itself is under stress. Central banks understand this perfectly. They are not trying to maximize quarterly returns. They are trying to preserve sovereign purchasing power through a changing monetary environment. Another thing most people don't appreciate is that central bank behavior tells you more than central bank language. Public communication is designed to manage expectations. Actions reveal incentives. When central banks say they are committed to stability while simultaneously increasing gold reserves, what you are seeing is not contradiction. What you are seeing is prudence. They understand that the current system can remain functional and still become weaker at the margins. They understand that inflation can be moderated and still remain structurally above what savers are prepared for. They understand that geopolitical conflict can remain below open war and still accelerate reserve diversification. In other words, they do not need the system to collapse in order to justify owning more gold. They only need the system to become less certain. And uncertainty is exactly what we are moving into. The world is becoming more fragmented. We are seeing more geopolitical rivalry, more sanctions, more questioning of dollar dependence, more interest in alternative settlement systems, and more strategic behavior from countries that do not want all their reserves tied to another country's liabilities. Gold fits naturally into that environment. It is politically neutral in a way that sovereign bonds are not. It is not frozen by a foreign government. It is not dependent on bilateral trust. In a world where financial power is increasingly tied to political power, owning an apolitical reserve asset becomes more attractive. Now, let's be clear about something important. This does not mean gold is the only answer, and it does not mean central banks are abandoning the fiat system entirely. What it means is that they are adjusting the balance between confidence and caution. They are reducing dependence on a single outcome. That is exactly what intelligent portfolio construction is supposed to do. And that leads to the lesson individuals should take from all of this. If the institutions closest to the monetary system are increasing their exposure to gold, then ordinary investors should at least ask whether their own portfolios are too exposed to fiat dilution. The average person is often structured entirely around the assumptions of the current system. Their wealth is mostly cash, bank deposits, bonds, retirement accounts, heavily dependent on financial assets, and maybe a home. What is usually missing is an intentional hedge against monetary debasement. That doesn't mean someone should panic and move everything into gold. Concentration is dangerous in any form, but it does mean that if you hold no assets designed to preserve value when currencies weaken, then you are implicitly betting that the existing system will remain stable in real terms. That may be a much riskier bet than most people realize. This is where the wealthy and sophisticated think differently. They do not ask what feels safest right now. They ask what will preserve purchasing power across multiple possible futures. That distinction changes everything. Wealth is not just cash. Wealth is claims on real value. Wealth is ownership of scarce assets, productive assets, and structures that adapt with inflation rather than being destroyed by it. Gold is one part of that. Productive businesses are another. Real assets are another. Human capital is another. The goal is not to guess one perfect scenario. The goal is to build resilience. If you study history, you'll notice that major wealth transfers rarely happen through a single dramatic event. They happen through long periods where one group holds depreciating assets while another group holds appreciating or resilient assets. The first group often doesn't realize what is happening until much later. They think they are being cautious. In reality, they are standing still in a moving monetary environment. The second group understands that when the value of money changes, Passivity becomes a decision with consequences. They reposition before it becomes obvious. Gold plays a role in that repositioning because it gives you exposure to an asset whose value tends to rise when trust in fiat money declines. Again, that doesn't mean gold always goes up in a straight line. It doesn't. It can be volatile in the short term. It can underperform other assets during certain phases of the cycle, but that is not why it belongs in a resilient structure. It belongs there because it responds differently than fiat-based assets. It provides diversification when the monetary environment becomes unstable. It helps preserve optionality. It creates balance when the rest of the portfolio is exposed to the credit system. This is why the question is not, will gold outperform everything? The better question is, does my portfolio contain assets that can preserve value if fiat purchasing power continues to erode? Central banks are answering that question with their balance sheets. They are saying yes. They are preparing. They are not betting everything on gold, but they are increasing exposure because they understand the world is changing. And in these periods, it is not enough to hold nominal wealth. You need real resilience. At this point, some people will say, if the outlook is so uncertain, shouldn't I just hold more cash and wait? That instinct is understandable, but it misunderstands the nature of the risk. Cash gives you liquidity, and liquidity matters. Everyone should have a buffer for emergencies, dislocations, and optionality. But beyond a certain point, excess cash in an inflationary environment becomes a guaranteed loser in real terms. It feels safe because the number doesn't fluctuate, but the purchasing power does. The danger of cash is that its decline is subtle. You do not experience it as a crash. You experience it as a slow decline in what your money can buy. That is often more dangerous because it fails to trigger action. The intelligent response is not to reject cash completely. It is to stop confusing liquidity with wealth preservation. Liquidity is for flexibility. Gold is for protection. Productive assets are for growth. Real assets are for inflation sensitivity. Human capital is for adaptability. This is how you begin to think like institutions that survive cycles instead of reacting emotionally to headlines. And this brings us to the practical implication of everything I've said. If central banks are buying gold because they see pressure building inside the fiat system, then you need to review your own financial structure with fresh eyes. How much of your net worth is exposed entirely to paper claims? How much of it depends on real interest rates remaining favorable? How much of it is protected if inflation stays structurally higher than expected? How much of it can survive a world where reserve diversification, debt monetization, and geopolitical fragmentation continue? These are not abstract questions anymore. They are portfolio questions. They are purchasing power questions. They are survival questions because the future of money is not decided by opinion. It is decided by incentives, debt dynamics, productivity, and confidence. And when confidence begins to shift, capital moves before the headlines fully explain why. That is exactly what we are seeing with gold. A quiet, methodical, global repositioning by the institutions that understand the system best. Most people will notice it late. They will see higher gold prices, more discussions about reserve diversification, more concerns about fiat purchasing power, and only then begin asking what happened. But by then, the signal will have already done its work. The opportunity always exists earlier. It exists when the evidence is visible, but not yet obvious. It exists when actions speak more clearly than official narratives. It exists when the world still appears stable enough that preparation feels optional. That is when positioning matters most. So here is the conclusion. Central banks are not buying gold because they are sentimental. They are buying gold because they understand how debt cycles end, how reserve systems change, and how fiat money behaves when policy runs out of easy options. They know that in a world of too much debt, too much money creation, and too much uncertainty, hard assets become more important. They know that trust in money is not permanent. And they know that when the future becomes less predictable, owning an asset outside the fiat system is not old-fashioned. It is rational. The real question is not whether they know something. They clearly do. The real question is whether you are willing to learn from what they are showing you, because wealth is not preserved by hoping the system remains the same. It is preserved by recognizing when the system is changing and preparing before everyone else does. That is what central banks are doing with gold right now. And if you understand the cycle, you understand why. Start looking at money the way sophisticated investors and institutions do, not as numbers to be accumulated passively, but as purchasing power to be protected intelligently. Think in terms of real value, not just nominal balances. Build a structure that can survive more than one future. And remember this, in every major transition, the people who prepare before the crowd are the ones who preserve freedom, flexibility, and wealth when the world begins to shift.